Skipton Building Society today have announced that they've reduced their buy-to-let stress rate. Now, for a lot of you that don't know what a buy-to-let stress rate is, when you're purchasing or remortgaging a buy-to-let property, so a buy-to-let property is an investment property that you own, lenders have something called a rental stress test. Now, determining the type of product you're taking, so for example, a 2-year product versus a 5-year product. On a 2-year product, the majority of lenders have a higher rental stress test versus a 5-year product where they've got a lower rental stress test. Now, what does that mean? That means that on a 2-year product, in essence, you can borrow less usually versus a 5-year product where you can borrow more because the rental stress test is lower. Now, this probably sounds confusing, but stick with me and I'm going to show you a real life calculation later in this video on how this buy-to-let rental stress test actually works and how a 2-year product versus a 5-year product can, in theory, you can borrow more or less depending on the product that you choose. So make sure you stay tuned. So this is just a screenshot of the email that I received from Skipton Building Society this morning. Here you can see, look, from today, Monday the 25th of March, we're making the below changes to our buy-to-let stress rate. So for products with a fixed term of less than 5 years, our buy-to-let stress rate is reducing to 7.05%. So less than 5 years is like a 2-year tracker, a 2-year fix, 3-year fix if they've got them available. And now here it says for products with a fixed term of 5 years or more, our buy-to-let stress rate is reducing to 5.99%. So how can these changes benefit yourself as a potential buy-to-let owner or someone who's looking to remortgage? Have a look at this calculator from Skipton Building Society website as of the 25th of March 2024, and you'll see exactly what I'm talking about. So for this example, let's assume that our clients are purchasing a buy-to-let property. Now they want to purchase a property worth £300,000 and they have 25% deposit, which is what the standard norm, what everyone thinks they need. So that's £75,000, right? And they need a loan of £225,000. It's not a remortgage. They want to take a 2-year fixed rate and they're not a buy-to-let property landlord and they are high rate taxpayers. So the rental income they've been told by the agent achievable for this property is £1,400 a calendar month. And what is the minimum rent that they need to be able to get that loan of £225,000? £1,916 a calendar month. So you can see here that if they wanted that loan of £225,000 on a 2 or 3 year fixed rate product, the rent that needs to be confirmed by the valuer who does the valuation for the property needs to be £1,916 a month. So you can see there's a clear shortfall here. Then let's look at what the maximum loan is on a rental of £1,400 a month. So assume £1,400. So they still want to buy a property worth £300,000, but the rental achievable for that property is £1,400 a month. So it's not a like-for-like remortgage. They're not taking a 5-year fixed rate. Their maximum loan on £1,400 a month is £164,343. So the deposit required with Skipton Building Society on a rental of £1,400 a month for a property worth £300,000 on a 2 or 3 year product is £135,657. So you can see here how it makes a big difference on the rental income achievable for that property. Now let's assume the client is opting for a 5-year fixed rate product. How much does this make a difference on the overall loan amount available on the example that we've just used? So we're back to our affordability calculator here. The only change we're going to make is a 5-year fixed rate product being taken. We're going to put yes. Now on a 2-year fixed rate product, the rental income needed was £1,916. What is the rental income needed if the client takes a 5-year fixed rate? £1,628. Massive difference. They still can't get the full loan of £225,000 that they need. But let's have a look here. If the rental income achievable for that property that they want to purchase for £300,000 is £1,400 per calendar month, they want to take a 5-year fixed rate. Now on a 2-year fixed rate, the maximum loan was £164,343. On a 5-year, it will be £193,426. That's a massive difference of £29,083. So you can see here the difference between a 2 and a 5-year product, depending on the rental stress test, makes a massive difference on the overall loan amount available. Now this is just the rental stress test with Skipton Building Society. Every other buy-to-let lender has a different rental stress test. So it's all about your broker finding you the right buy-to-lender according to your circumstances. But you can see here the rental income and the product you choose is a key factor in how much you can borrow as a mortgage loan. The old myth of you need only 25% deposit to buy a buy-to-let property, yes, that is the minimum deposit required, but that doesn't mean you are definitely going to get that 75% mortgage loan that you need for the property that you want to purchase. You need to take into consideration the rental income achievable for the property. You need to take into consideration if you want to go for a 2 or a 5-year product, because ultimately that is going to determine how much you can borrow as a mortgage loan. And the difference between how much you can borrow as a mortgage loan and how much the property is valued at is what you need to put as your deposit. But always remember, even though the agent may tell you that this is the anticipated rental income achievable for that property, the lender is always going to go by what their valuer says. So they will instruct the valuation. The valuer will go to the bank and say, yep, I think it's worth this much in terms of rental income every single month. And that is what they're going to base their lending on. But remember, every lender has a different rental stress test. So what I've shown you today will be completely different with another lender within the market. Have you ever thought that you could easily get the 75% mortgage loan, and then what happened is the rental income didn't stack up for the loan amount that you required? Let me know in the comments.